All right, so we are getting into the New York cannabis taxes, which is going to be very interesting. It is one of the largest states when you think about in terms of population and you think about the potential that it has in revenue. So it's going to be very interesting to see how the local and the state taxes play out and if there will be changes later on. But this webinar is going to just really walk us through New York State cannabis taxes, the compliance that you need to know and to be aware of right now, and how to really set up a business for success to make sure that there really is no crazy tax liability at the end of the quarter, at the end of the year that you as the accountant or you as the business owner just were unaware of. So let's get into it. So where we are right now in New York, at the moment, there are still no adult use sales. That is going to be expected for late 2022, early 2023, depending where we are in the regulation. So currently, regulation is being drafted. It is actually already there for public comment, and we have not had a finalized set of regulation in the state of New York. But what we can gather from the law that's actually been written, and I'm going to reference that a lot in this presentation because the law is where we're getting the tax information. The law is where we're getting the distributor requirements. That is something that we can already reference and we can already prepare for businesses who are getting set up, who are predicting their cash flow, who are looking for investing and investment funds. So New York, similar to a lot of the different states, has multiple licenses. If you think about it, it starts at the very beginning. So a nursery going down to a cultivation, distributor, retail and delivery, and then businesses can elect to have a micro business, which is an option to have, a vertically integrated business. There are cooperatives, there's on-site consumption licenses, and there are registered organization licenses. Now, not all of these licenses have a tax impact, but you'll notice that as you start looking through the supply chain, the nursery, the cultivator, the processor and the distributor are all licenses that are absolutely impacted by the tax. The retailer and delivery also are, but from a profit perspective, it's really going to impact the nursery, cultivator, processor a lot more than it will the retailer. Everyone's impacted, but you'll see it a lot more in these guys. As I said, we are still at the comment period on regulation, so nothing's set in stone. Applications have begun, and what we can really ascertain at the moment is the cannabis taxes, which we're going to go over. And the reference, if you are interested in actually reading this, you can Google the New York State Senate Bill S854A, and that's where you'll get all of this information. So when we start really thinking about cannabis and how things are impacted, what's very unique about the state of New York is that tax is calculated based upon THC. So it's really important for us to go back and look. Now that we kind of even know that at a high level, it's really important for us to say, okay, what's the definition by the state of New York for THC? So THC means Delta 9, which THC had always been Delta 9, but what's interesting is that Delta 8 is considered THC at the state level, as well as Delta 10. So in many states, this wasn't the case. So if a business has a product that is related to Delta 8 or Delta 10 in New York, that is still considered THC. Okay, so that's really important when you think about the calculation. Total THC means the sum of the percentage by weight or volume measurement of tetracannabinolic acid multiplied by 0.877. Plus the percentage of weight or volume measurement of THC. So we'll get into that. And then such regulation, so this is also part of the regulation, not the definition of THC, but such regulation shall also require product labels to accurately display the total THC of each product. This is very important. I'm going to talk about this in the compliance section, but these are when I started really kind of doing my analysis of like, okay, how our business is going to be impacted in the state of New York. I first needed to understand how is it calculated. We're about to talk about that. that, but THC is the main driver of that. The percentage of THC is the main driver of that. And then the next thing you always want to make sure is that, well, how is the state actually defining this? If I dive back into the law, if I go look at that, because that's all that we have, the law really, the regulations add upon the law, how does the actual state define it? So that's really important. So recognize that THC is Delta 9, 8, and 10. This is very unique. So this graph is pretty big. I'll walk us through it. The cannabis taxes there's 3 cannabis taxes that a business in New York has. The most important one we're going to talk about is the cannabis state tax. Now, this is a tax that is imposed on the distributor. So along the supply chain, the distributor is the one that the tax is imposed on. The cultivator doesn't have this tax, the processor doesn't have this tax, the nursery doesn't have this tax until it gets to the distributor. Only the distributor has this tax. The tax is calculated based off of the milligrams of THC in the product. By different categories of our products, so we've got edibles, we've got concentrates, we've got cannabis flower, all of those different product types have a different tax rate or a tax conversion, right? Because it's not a percentage, it's a dollar amount over a milligram, but each of those has a different amount. So edibles is not even 3 cents. Hey, Christy, not even 3 cents, but it is 0.003 of a cent milligrams, right? Concentrates is less and cannabis flower is less. Now, what's unique about this, and I'll show you an example of this, is that it doesn't vary by revenue. This only varies by the actual product type and the milligrams of THC. So we don't care about CBD. We don't care about the unit of measure in terms of the weight of a product. We need to have both the unit of measure and the percentage of THC that is in that product type to actually calculate our taxes, which is crazy. Like, I've never seen this before. Apparently, Connecticut has a very similar version of this, right? But that is, along the West Coast and states that have already, been working with regulated cannabis from an adult use and a medical perspective for multiple years. They've never done this before. So I'll show you how this is impacted. So those are the drivers of calculation. But what's interesting is that so that's the driver of the calculation. When does this accrue? So this would accrue when the cannabis has actually been sold from the distributor to the retailer. So that is something that the cannabis distributor would, accrue in their books that probably won't be charging, right? It's not an expense towards the retailer. We'll see how it actually works into business, but that is an expense at the distributor level and a tax that's payable at the distributor level. So very interesting. So that's one of the taxes. We also have a state excise tax, which is imposed on the sale of cannabis products by a retailer. So this is when somebody goes into a retail dispensary, probably on-site consumption would follow under retail, as well as the distributor would follow under retail. And that would be charged at 9% of the product's price. So there is another tax, but it's definitely passed along to the consumer. Then there is a local excise tax that is imposed on the sale of cannabis products by a retailer to a cannabis consumer at 4%. So we are seeing 13% directly to the consumer, and we're seeing at the distributor level a fixed amount based upon not a percentage of sales, but on the actual THC amount that there is in the product. So this is in addition to IRC 280E, right? So this is just what we're looking at the local and the state level. It's wild. I'll go through an example, but questions here, because this was what was like very interesting to me. I've never seen it this way. All right, we'll move on. So my observations financially is that this onus is on the distributor. However, the entire supply chain will be impacted by this. Tax is not based off of revenue or sales, which typically it has been in other states. And with the price fluctuations that happen in a new emerging market, right? So New York, the supply and the demand are really, at the moment, we can't even buy cannabis, right? But when the businesses start being able to open and start having product and demand starts to happen, there is going to be it will not reach market stability for a long time in the state of New York, right? For the first years, we're going to see that demand is going to be greater than supply. But as regulation starts to happen and more businesses are licensed and the market really kind of starts to find itself, we're hopefully going to see that supply and demand are more equally matched. Now, what happens with that? That means that price is going to fluctuate. Price meaning price at the retail level that's going to get pushed down all the way to the all the way down to the supply chain. Now, why that's interesting and why that's really important for us to be thinking about even today before all of that has happened is that that's going to impact how businesses margins are and the health of those business margins, right? So if I know that I'm selling some edibles, and let's just talk about it at a unit at a retail level in a market that's not fully mature, and I'm selling it at maybe $25 per unit. I know when that market matures, and looking at past data and other markets in the United States that already have that adult use, that price is probably going to go down. That price might go down from that amount to maybe 10. So how is that going to impact my margin when I know that I still have to pay that tax that has nothing to do with the price that I'm going to be selling it to? That's a really important observation just to be thinking about when you're working with businesses and really analyzing the margins today and looking at, okay, well, how's that retail price if we, sell at this much versus another variable amount, what's our break-even point? What are our fixed costs? And really making sure that you're even clear on the variable costs. Like that is already something that you want to be focused on. Now, pricing discounts are a great way to push product and to get market share. It's what businesses along the supply chain do to get into dispensaries, to get shelf space. Like that is just something that happens. Now, if a business wants to offer a discount to grow and gain market share on their product, that is not going to impact the tax. So they're still going to be paying this quote unquote fixed tax based upon the amount of product they're selling multiplied by that percentage of THC. Very unique. There are some asterisks under that because there is something in the law currently that doesn't make it seem that likely that distributors will actually be able to offer price discounts. Now, regulation can change that. The law evolves, and probably by the time that anybody's watching this recording, that aspect might have changed. But currently, that doesn't even seem like that's going to be worthwhile from a financial perspective and maybe even from a regulatory perspective. Now, when I also think about it, I think about, okay, so that's the high level profitability, how things will look. But if we start getting into the nitty gritty of things, of actually saying, okay, well, we're about to launch a manufacturing business and we have 30 product SKUs and different variations and all of that kind of stuff. Well, how are you going to even set that product mix up initially and those tax calculations if you are a distributor, right? Processor, nursery, cultivator, that doesn't really matter. We need to include that in our profit margins, but I'm just talking at the distributor level. So there's a lot of emphasis in the distributor to make sure that they have their accounting completely dialed in, their product listings completely dialed in, their calculations of taxes completely dialed in because the amount of tax needs to accrue the moment that it's being sold. The current law doesn't state when the tax needs to be paid, but typically the payment to the state usually is within the month, right? So from a cash flow perspective, it doesn't even make sense. Like if you are having that expense and you're accruing it on the books and that's by the law, of course you're restricting that cash to a different account to make sure that you have allocated that amount to pay the state. Products that are not standardized in product formulation are really going to require review of taxes if the THC fluctuates. So if there are operators that haven't defined good processes in their manufacturing and don't have standardization within their products, let's say that they do a batch of edibles and one edible is maybe a certain percentage of THC versus another percentage of THC, or a business likes to innovate a lot and really kind of think about new innovations and new different products. Well, each time that there is something new and unique, it's going to have to go through the system of putting it in to the accounting system and making sure that the tax is calculated appropriately. So there's a lot of extra work and onus for the distributor. From a retail perspective, unfortunately, that's a tax that's just going to be passed upon to the consumer. There's nothing that I read so far that disallows the retailer or the delivery or the on-site to take the to almost put it into the price of cannabis, the tax. But from a compliance perspective, you probably still need to list that out, and it would just be messy and not good for margins if the business did that. So from a demand perspective, consumers in New York that have been purchasing either medical or in the illicit market, who all of a sudden decide to go to a retail establishment, are definitely going to feel that price hit because of the taxes. They're going to feel it because of the excise tax at the state and the local level, the 9% and the 4%, but they're also going to feel it because of the impact of the supply chain of that cannabis tax that the distributor has. And what do I mean by that? I mean, because if a distributor knows that they have to pay the tax to the state, how do you think the negotiation is going to go with a processor, with a cultivator, with a nursery to sell their products? Well, the distributor might have more push and more flux to push down the price that they are going to be buying it from the supply chain, which obviously will impact the cash flow of the entities that are downstream, right? So very, very interesting to think about. So I guess you might be thinking like, well, how do we even calculate this tax liability? So what I would imagine you'd want to do is create a product listing to detail out each product category. So we know if we're working in the distributor level that we have concentrates, that's a certain tax rate. We've got edibles, that's a certain tax rate. We've also got flour, that's a certain tax rate, right? We know those things are fixed. So that would be step one, is like our product categories with the tax rate that is there. I would put this in a Google sheet. It's going to be the easiest to maintain, and that would be almost the approved product listing. Now, the products then would be, if you have 30 SKUs, 100 SKUs, who knows how many SKUs, you would then list them out line by line, product description. This would also go into the metric system, product description, unique identifier, what is the unit of measure. You will need to figure out a way to convert the unit of measure to milligrams. So if you are in a business that is, and I'm imagining, the big one would be if you are selling eighths or ounces, right? If flour, like how do you make sure that you translate that to milligrams? But you want to make sure that you have a very standard way of doing it so everything is consistent. And then you would apply the rate of THC that one product has. So let's say that I'm selling flour of 27, like that's a 27% THC, and I'm selling a gram of flour. Well, I know that 1 gram equals 1,000 milligrams multiplied by 27% would give me my number. Now, what's interesting is that this needs to tie out to the product label. What do I mean by that? So remember at the very beginning, there is like something that under the THC definition is that everything is required. The tax actually will be, if they're getting audited, is going to be tied back to each product is going to have the amount of THC listed on their product label, right? So this gets a little sticky for a few reasons from a compliance perspective. So that would just need to make sure that's like your double check as the accountant and the finance responsible, that all of that matches. Because if it doesn't, and what happens and somebody comes back and there's an audit that happens, they're going to go, it doesn't matter what your spreadsheet says, they're going to go to the product label, right? That's what actually hit the market. So that's the very high level of how you calculate it. Questions on that? All right. And if you have questions later on, you can leave them in the chat and I'm happy to answer them, but that's the high level. From a requirement, from a books and records standpoint, and from what you want to make sure that you are implementing for cannabis businesses, much more from the financial control perspective, this is taken from Senate Bill S-854A. So each distributor shall keep and maintain upon the licensed premises adequate books and records, of course, of all transactions involving the business transacted as such a distributor, which shall show the amount of cannabis products purchased by such distributors and the total THC content of purchased cannabis products as reflected on the product labels together. That's very important. That is something that for every transaction needs to be maintained. And then, so that's from the distributor dealing with the nursery, the cultivator, or the processors. And then from a sales perspective, they're also going to make sure that the number of cannabis products sold to the retailers and the delivery and the on-site consumption, and the total THC content of cannabis products sold as reflected on the final product labels. So those are the two important variables that we want to make sure that as accountants we're very, very clear of. Record keeping requirements, there's three main things. This is really consistent with a lot of states. So each sale shall be recorded in a separate invoice, which shall have printed there on the number, the name of the license, the address of the license, and the current license number. So that's just standardization right there. And such distributor shall deliver to the purchaser a true duplicate invoice stating the name and the address of the purchaser, quantity, total THC content, description of the brands and the price, true and accurate and complete statement of the terms and conditions. Okay, so that's very, very simple. And then record keeping requirements in the state of New York, it's 5 years. So not 7 years like some of the states. So that's 5 years. Always safe if you have in your record keeping policies to have 7 years, because if that business operates in multiple states, you should be very, very clear on that. We've talked about this one, so that's a duplicate slide, but my compliance observations is that tax is calculated on THC on the product label. So I've kind of hammered that down, but it's really important because in an audit, that's where the regulatory body is going to go. They're going to go to the THC on the product label. There can be very costly errors if there is no review of the accuracy of product labels. Like that is a control that needs to be happening at the distributor level, well, at any level in any business, but if we're just like focusing on the distributor, finance needs to have some view on this and some oversight on this. And this typically isn't something that finance or the accounting team is really involved in, but definitely is something that you need to be involved in, just starting to look at that. And then vendor purchasing controls are needed to ensure the compliance with record keeping, right? So that's really important. And then customer controls are needed to ensure compliance with invoicing and tax requirements. So again, making sure that you have the best practices with purchasing and payables, and then revenue and receivables, just to make sure that the compliance is there, right? That you've standardized everything. But overall best practices, and this is what we really don't see oftentimes in a very emerging new market is that things need to be in writing and stated with contract terms. That will be one of the best controls to put in place between people and between entities in the supply chain. Now, that often doesn't happen. As the finance responsible, I hope that that's something that you can push, because that will just help navigate this whole uncertainty that will happen with this tax, because people are going to get very, very confused. Stakeholders are going to get very confused on who's supposed to do it and how things look and how the invoicing needs to be. So things should be stated clearly and in terms. Building a strong financial foundation from the start is pivotal. So making sure that you are setting up the accounting really well, right? So making sure that there's integration in all of the systems, that you have the system completely dialed in from when purchases happen, that there's controls in place, and that there's standardization of purchase orders and like a three-way match on everything from payment to receiving, and that there's some validation in between that you can really get clear on all of the vendor requirements, but then on the same stance as well on the invoicing for the customers, because from a distributor perspective, that's when everything happens. Now, if you're a retailer, if you're working with retail businesses, stated terms would only be for everyone below them, right, in the supply chain, so the distributors. And the financial foundation is absolutely the same. That would just be using any point of sale system, just integrating the taxes that would happen, and that should be automated, because there's nothing that would be unique necessarily to a product category for a retailer. But it's important, and point number 3, that you get everyone on deck. This is not just a finance role. Like, as I see when you're thinking about this tax at the distributor level, sales needs to be involved and operations needs to be involved, because there's so many different things that operationally could impact the tax that if finance is unaware of, it's going to be pulling a lot of teeth. It's going to be a lot of band-aids for the business when it doesn't have to be. So really figuring out how you can streamline and get operations, sales, and finance together, even if it's, first at the initial setup, and then every month, every quarter, what processes do you have in place to make sure that you are checking in and that everything is going as planned, right? So again, it's just the continually monitoring of the controls that you're setting up. And then for the business operators, as accountants, it's important that we do the monthly financial reviews. Like, this is not just sending them the profit and loss statement and the balance sheet. This is literally going over profitability, because the tax is really going to impact the entire supply chain. And so it's looking at overall profitability. It's looking at product margins on unique categories. So you can start building your key performance indicators and a dashboard to really look at how things are going. It's looking at inventory turns. It's looking at the accruals for taxes, absolutely, and doing those tax reviews. And so when you think about that tax review, state, local, federal is the IRC 280E, because we haven't even put this on we haven't even put IRC 280E on this. So those are some of the best practices as you're starting to work with businesses in New York to make sure that you have. That's it. Like, it's a quick thing. I'm so curious if you have questions on the tax and really how it's calculated. What's interesting here is, so this is just like a little observation thing that I did. So I took 3 products, like 3 categories, right? So I went in on, I suggest always doing this, go to Ease to get pricing in California or in Michigan. And I was like, okay, well, let's just see like what current market price is. And let me look at the categories. So I have a flower, I have a concentrate, I have an edible. And I went to the product and I saw, okay, well, what's the weight? So 3.5 grams, 0.5 grams, 100 milligrams. So that's like literally what the product description said. Unit of measure. So that's what you always want to do, is have like a unit of measure. And then total milligrams you'll have. So this is the conversion I was talking about. right? So I'm just multiplying it by 1,000 here. But if this was ounces, or this was like an eighth, which would be an eighth of an ounce, I would need to have a different conversion. But the whole thing is, to calculate tax, we have to get to a total mg. Like, we have to, per how the law is actually written, right? Like, that's just how it currently is written. The percentage of THC, that is something that the product, like when it gets lab tested, you will have this information, right? This is something that you're not going to go just like, hey, what is it? Like, you want to validate that against the products that have been tested, because that's going to really hit the product pricing. So it was 27%, 74%, and then 100%. And just so you know, orange gummies, it's an edible, it's a 10 pack. So the thing that this calculation doesn't show is that these are units, but if we're talking about a distributor, we're buying boxes, right? So we would need to add an additional thing to make sure that we would have the quantity correct. So this gets us the percentage of THC and then the total mg THC. So I just got that amount, right? Because that's the driver of the tax. Here's the tax. So we've got, hold on, I just like to have them all. Oops. There we go. So here's the tax that I was showing you before, and then here's the estimated tax, right? So it's just math. So it's tax rate times the total MGs. That is our estimated tax. So that's cool, right? That's like very interesting. But why this is actually something that we have to really figure out in terms of, like, as a mastermind, like, I want people's feedback, is like, I'm like, okay, that's great, but let's now take this one step farther and actually look at what the retail prices were at the dispensary level. Ease is a delivery service. Okay, so this is how I'm getting these numbers. This would tie, I went online, this is how much they're selling it for. So retail price is $19 for Legend OG, but our tax is $4.7. Retail price is $15, our tax is $2.96. Orange gummies, our retail price is $10, but our tax is $3. And so let's kind of dive in a little bit more into this. So I got those retail amounts. So I'm actually keen to know, it's great to know my retail amount, but I'm going to assume that I'm the distributor. I'm going to assume that a distributor has about, they mark it up twice, right? So let's just imagine that it's 50% of the cost, right? So if the retailer is selling it for 19, they bought it from the distributor for $9.50. That's an assumption. This little thing right here, that's the driver of the assumption. So let's say I put 35%. That's going to change my distributor cost. Okay, so that's just their margin. But let's keep it at 50% right there. And then the next one is their cost of goods sold. So that's our distributor cost. So now I'm like in the mind of the distributor. I'm like, okay, so that's how much money as a distributor I'm about to be making from this one sale. So I then apply another for 50% margin to get my cost of goods sold. Why am I doing this? Well, we know that a distributor is a reseller in terms of like how the IRS looks at it for 471, right? So that is going to just be the price that they actually bought it from the processor or from the manufacturer or from the nursery or from the cultivator. Like, that's the price right there. So again, I'm using an assumption that it's 50%. That can change, right? So depending on this distributor and who it is. So I'm like, okay, so I got my new sales price for the unit, assuming I'm a distributor. So I guess it could be distributor price. I've got my cost of goods sold. I've got my tax. That tax is just taken over from total estimated tax. And now I've got my gross profit. Oh, what? My gross profit is horrible. Do you see this? Like, this is where I'm like, I think there's a big issue here. Like, our gross profit is like 2 cents. That means we don't have enough money in this selling this one unit, but we can multiply it, right? Because we can just look at this percentage is a better indicator. GM, gross margin, is the best indicator to know if it's profitable or not. Like, we look at that and we're like, oh my God, like, this is not good. This is what I'm talking about, needing to assess the profit margins on the prices. Because this, if they sold the Legend OG and their whole sales strategy is about Legend OG, they're not going to have enough costs to like cover taxes, to cover operational expenses, to cover anything. And even if they're selling orange gummies, geez, like they're operating at a loss on this product. So it's important as accountants to really make sure that like we are very clear on this tax, and that you also, really get focused on helping these businesses make sure that they have a good plan in place. So this is just kind of what it looks like from there. And I feel like, yeah, I mean, like I'd love for everybody to, at this moment or later on, to chime in. Hopefully you can find an error in my work, because when I did this, I was like, wow, this is not setting up these businesses for a success, especially down the supply chain. So yeah, guys, or ladies, that's it. Like, I just wanted to, get feedback really and show you kind of how I go about working in a new market, and just understanding the taxes and the tax implications. Because what I've seen in a lot of states is that the business operators just don't understand and hear misinformation and don't even know about that they can access this stuff currently. And then along the supply chain, it's a lot of like shake of the hands type of contracts, and there's not clarity. And this is where a lot of small businesses really will suffer, because they don't have the cash flow to navigate this, where maybe an MSO or somebody that's like more venture backed could navigate it, but not for a long time because of these margins.